What if I told you the difference between a losing trader and a profitable one is not strategy, not indicators, not even experience? It's something far more uncomfortable, something most traders spend years avoiding, and the moment you finally accept it is the moment everything changes. Most traders begin their journey believing that somewhere out there exists a perfect strategy, one that never fails, one that delivers consistent wins, and one that eliminates uncertainty. They spend months, sometimes years, jumping from one system to another, constantly tweaking indicators, changing time frames, and searching for that magical formula. This obsession feels productive, but in reality, it keeps them stuck. What they don't realize until much later is that the problem was never the strategy itself. The problem was their belief that perfection exists in an imperfect environment. The truth is, the market is driven by uncertainty. No indicator, no pattern, no strategy can predict price movements with complete accuracy. Even the best setups fail. Even the most experienced traders take losses. This is not a flaw in trading, it is the nature of trading. And once this reality is fully accepted, everything begins to change. Instead of wasting energy trying to eliminate losses, traders start focusing on managing them. This shift in thinking is what separates amateurs from professionals. Beginners want to avoid losses at all costs. They hesitate to enter trades because they fear being wrong. They exit too early because they fear losing profits. And when they do lose, they often take it personally, as if the market is somehow against them. This emotional roller coaster leads to inconsistency and frustration. On the other hand, profitable traders accept losses as part of the game. They don't expect every trade to work. They don't need to be right all the time. What matters to them is executing their plan with precision. Execution is where the real edge lies. A simple strategy executed with discipline and consistency will always outperform a complex strategy driven by emotion and doubt. This is why two traders can use the exact same setup and achieve completely different results. One follows the rules strictly, manages risk properly, and stays patient. The other second guesses every decision, moves stop losses, overtrades, and lets emotions dictate actions. The outcome is predictable, not because of the strategy, but because of the mindset behind it. Understanding that no strategy is perfect also removes a huge psychological burden. It frees traders from the constant need to fix things after every loss. Instead of reacting emotionally, they begin to think in terms of probabilities. They understand that a losing trade is just one event in a long series of trades. It does not define them, and it does not invalidate their system. This perspective creates stability, which is essential for long-term success. Another important realization is that simplicity often works better than complexity. Many traders believe that adding more indicators or rules will increase accuracy, but in most cases it only creates confusion. A clear and straightforward approach is easier to follow and easier to execute consistently. And in trading, consistency is everything. It is not about how much you win on a single trade, but how well you perform over hundreds of trades. Letting go of the idea of a perfect strategy is not easy. It requires humility. It requires accepting that losses are inevitable and that control is limited. But this acceptance is also empowering. It shifts the focus from external factors like the market or the strategy to internal factors like discipline, patience, and emotional control. And those are the areas where true improvement happens. In the end, every profitable trader comes to the same conclusion. Success does not come from finding perfection, but from operating effectively within imperfection. The sooner this lesson is learned, the sooner progress begins. One of the hardest lessons a trader will ever face is realizing that the market is not defeated by intelligence, but by discipline. At the beginning, most traders believe that success comes from analyzing charts better than everyone else, finding smarter entries, or predicting price movements more accurately. They spend countless hours studying patterns, indicators, and strategies, thinking that more knowledge will automatically lead to better results. But over time, something frustrating happens. They still lose money even when they know what to do. This is where the real truth begins to reveal itself. Knowing what to do is not the same as actually doing it. There is a massive gap between knowledge and execution, and that gap is filled with emotions. Fear, greed, impatience, and doubt quietly take control in critical moments, causing traders to act against their own plans. This is why discipline becomes far more important than intelligence. You can have the best strategy in the world, but if you cannot follow it consistently, it becomes useless. Fear is often the first emotion that disrupts discipline. A trader may see a perfect setup, one that fits all their rules, but hesitate to enter because they are afraid of losing. They start overanalyzing, looking for extra confirmation, and by the time they finally act, the opportunity is gone. Or worse, they enter late and get caught in a reversal. On the other side, fear also causes traders to exit winning trades too early. The moment they see a small profit, they rush to close the trade because they are afraid the market will take it away. In both cases, fear prevents them from following their plan. Greed is just as dangerous. After a few winning trades, traders often feel invincible. They start increasing their position sizes beyond what their risk management allows. They ignore their rules, chasing bigger profits, believing they cannot lose. This overconfidence leads to reckless decisions, and eventually one bad trade wipes out all their gains. Greed convinces traders to abandon discipline in pursuit of more, but it often results in losing everything they have built. Then there is impatience. Markets do not always provide opportunities. There are periods of waiting, sometimes long and frustrating. Undisciplined traders struggle during these times. They feel the need to be in a trade as if doing nothing is a waste of time, so they force trades that do not meet their criteria. These low-quality trades usually end in losses, not because the market is unfair, but because the trader refused to wait. Discipline, in contrast, allows a trader to sit still, to do nothing when nothing is there, and to act only when the right moment arrives. Doubt also plays a major role. After a few losses, even a good trader can start questioning their system. They hesitate, skip valid setups, or change their approach entirely. This inconsistency breaks the cycle of probability that their strategy depends on. A disciplined trader understands that losses are part of the process. They trust their plan and continue to execute it, knowing that over time, the edge will play out. Discipline is not something you are born with. It is something you build through repetition and self-awareness. It means following your rules even when it feels uncomfortable. It means taking a loss without reacting emotionally. It means sticking to your risk management no matter how confident you feel. Most importantly, it means treating trading like a process, not a series of random decisions. In the end, the market rewards those who can control themselves. Intelligence might help you understand the game, but discipline is what allows you to survive and win it. One of the most important shifts a trader can make is understanding that trading is not about certainty, it is about probability. In the beginning, most traders approach the market with a need to be right. They analyze charts, study patterns, and build strategies with the expectation that if they do everything correctly, the trade should work. When it doesn't, they feel confused, frustrated, and sometimes even betrayed by the market. This mindset creates emotional pressure because every trade starts to feel like a test of their skill or intelligence. But the reality is very different. No matter how strong a setup looks, no matter how much confirmation you have, there is always a chance that the trade will fail. The market is influenced by countless factors: news, liquidity, global events, and the behavior of other participants, all interacting in ways that cannot be fully predicted. This means that uncertainty is not an exception in trading, it is the foundation of it. Once a trader truly understands this, they stop trying to eliminate uncertainty and instead learn to work with it. Thinking in probabilities changes everything. Instead of asking, "Will this trade win?" a trader begins to ask, "Does this trade have a positive edge over time?" This is a completely different way of thinking. It removes the emotional attachment to individual outcomes and shifts the focus to long-term performance. A single trade no longer matters as much because it is just one event in a larger series. Just like flipping a biased coin, you may lose a few times in a row, but if the odds are in your favor, you will come out ahead over many attempts. This mindset helps traders stay calm and objective. When a loss occurs, it is no longer seen as a personal failure. It is simply part of the distribution of outcomes. There is no need to panic, no need to change the strategy immediately, and no need to chase the next trade to recover losses. Instead, the trader continues to follow their plan, trusting that the probabilities will play out over time. This level of emotional stability is what allows consistent execution. It also changes how traders manage risk. When you understand that any trade can fail, you naturally become more cautious about how much you risk. You stop placing oversized trades based on confidence or intuition because you know that confidence does not change probability. Even the best setups can lose. By controlling risk on every trade, you ensure that no single loss can significantly damage your account. This is what keeps you in the game long enough for your edge to work. Another important benefit of thinking in probabilities is that it reduces overanalysis. Many traders get stuck trying to find perfect confirmation before entering a trade. They add more indicators, look for more signals, and wait for everything to align perfectly. But this often leads to missed opportunities or late entries. When you accept that no trade is guaranteed, you stop looking for perfection and start focusing on consistency. If a setup meets your criteria and has worked over time, that is enough. You take the trade and let the outcome be what it will be. This approach also builds patience. You understand that results come from a series of trades, not from one big win. There is no need to rush or force trades. You can wait for your setups, execute them properly, and move on. Over time, this disciplined repetition creates a steady curve of performance rather than a chaotic series of wins and losses driven by emotion. Ultimately, embracing probability is about letting go of control. You cannot control the market and you cannot control the outcome of any individual trade. The only thing you can control is your behavior, your entries, your exits, your risk, and your mindset. When you align these elements with a probabilistic approach, you stop fighting the nature of the market and start working in harmony with it. That is when trading begins to feel less stressful and more structured, and that is when real consistency starts to emerge. One of the biggest misconceptions in trading is the belief that success comes from big wins. Many traders enter the market thinking they need to catch massive moves, double their accounts quickly, or find that one trade that changes everything. This mindset is driven by excitement and the desire for fast results, but it often leads to inconsistency and failure. What most traders eventually learn, often the hard way, is that real success in trading does not come from occasional big wins, but from consistent, small, disciplined actions repeated over time. Consistency is not exciting. It does not give you the adrenaline rush of a huge winning trade. In fact, it can feel boring and repetitive, but that is exactly why it works. Consistency is about following the same process every single day, regardless of how you feel, regardless of recent wins or losses, and regardless of what the market is doing. It is about creating a routine and sticking to it with discipline. At its core, consistency means executing your trading plan without deviation. If your strategy tells you to enter a trade under certain conditions, you take it. No hesitation, no second guessing. If your rules say to risk a fixed percentage of your account, you follow that rule every time. If your plan requires you to exit at a certain level, you do not move your stop loss or take profit based on emotions. This level of discipline creates stability, and stability is what allows long-term profitability. The reason consistency is so powerful is because it allows the law of large numbers to work in your favor. A single trade does not define your success, but a series of well-executed trades does. Even a strategy with a modest edge can produce strong results if it is applied consistently over time. On the other hand, even the best strategy will fail if it is applied randomly or emotionally. This is why two traders using the same system can have completely different outcomes. One is consistent, the other is not. Another important aspect of consistency is risk management. Profitable traders do not take unnecessary risks in pursuit of quick gains. They understand that protecting their capital is the first priority. By risking a small controlled amount on each trade, they ensure that no single loss can significantly damage their account. This steady approach may seem slow, but it creates a strong foundation for growth. Over time, small gains compound and the account grows in a stable and sustainable way. Consistency also helps reduce emotional stress. When you have a clear process and you follow it every time, there is less room for doubt and anxiety. You are no longer making random decisions or reacting impulsively to market movements. Instead, you are operating within a structured framework. This sense of control over your actions, even if you cannot control outcomes, creates confidence. And that confidence is not based on winning every trade, but on knowing that you are doing the right things repeatedly. One of the challenges traders face is maintaining consistency during difficult periods. Losing streaks are inevitable and they can shake your confidence. This is where many traders break their own rules. They increase their risk to recover losses, skip valid setups out of fear, or abandon their strategy entirely. These reactions destroy consistency and often make the situation worse. A disciplined trader, however, understands that losing streaks are part of the process. They continue to follow their plan, trusting that their edge will play out over time. It is also important to understand that consistency extends beyond just executing trades. It includes preparation, review, and self-improvement. Consistent traders analyze their performance, identify mistakes, and make gradual improvements. They treat trading like a professional activity, not a gamble. This commitment to continuous improvement strengthens their edge and reinforces their discipline. In the end, consistency becomes your true advantage in the market. It is not something you find, it is something you build through daily practice and commitment. While others chase quick wins and shortcuts, consistent traders focus on the process. And over time, that process delivers results. At some point in every trader's journey, there comes a realization that changes everything. The market is not the real opponent. You are. Most traders spend years trying to master charts, indicators, and strategies, believing that the key to success lies in understanding the market better. They analyze price movements, study patterns, and search endlessly for an edge. But despite all this effort, many continue to struggle. The missing piece is not knowledge of the market, but control over themselves. The truth is, the market is neutral. It does not target you, it does not react to your decisions, and it certainly does not care about your emotions. Yet traders often behave as if it does. They feel frustrated when a trade goes against them, overconfident after a win, and desperate after a loss. These emotional reactions lead to impulsive decisions, entering trades without proper setups, exiting too early out of fear, or holding on to losing positions in the hope that the market will turn around. Over time, these behaviors create a pattern of inconsistency that no strategy can fix. Mastering your mind means becoming aware of these emotional patterns and learning how to control them. It starts with recognizing that emotions are a natural part of trading. Fear, greed, and doubt will always be present, especially when real money is on the line. The goal is not to eliminate these emotions, but to prevent them from influencing your decisions. This requires discipline, self-awareness, and practice. One of the most important aspects of mental mastery is developing emotional detachment from individual trades. When you are emotionally attached, every trade feels personal. A loss feels like a failure, and a win feels like validation. This creates a cycle where your confidence rises and falls with each outcome, making it impossible to maintain stability. A strong trader, however, views each trade as just one of many. They do not define themselves by the result of a single trade. Instead, they focus on whether they followed their plan correctly. This shift in perspective reduces pressure and allows for clearer decision-making. When you are not trying to prove yourself right, you become more objective. You can accept losses without frustration and take profits without hesitation. You begin to see trading as a process rather than a series of emotional highs and lows. This is where consistency begins to develop. Another key element of mastering your mind is patience. The market does not move on your schedule. Opportunities come and go, and sometimes there are long periods where the best decision is to do nothing. Many traders struggle with this. They feel the need to be active, to always be in a trade. This impatience leads to overtrading and poor decisions. Mental discipline allows you to wait for the right setups, to stay calm during quiet periods, and to act only when your conditions are met. Self-control also plays a major role in risk management. It is easy to follow rules when things are going well, but much harder during losing streaks or after big wins. A trader who has not mastered their mind may increase risk out of frustration or confidence, both of which can lead to significant losses. A mentally strong trader sticks to their risk parameters regardless of circumstances. They understand that long-term success depends on protecting capital and maintaining consistency. Building this level of mental strength takes time. It requires honest self-reflection and a willingness to confront uncomfortable truths about your behavior. Keeping a trading journal, reviewing your decisions, and identifying emotional triggers can help accelerate this process. Over time, you begin to notice patterns in your actions and learn how to correct them. In the end, mastering your mind is what transforms an average trader into a consistently profitable one. Strategies can be learned and techniques can be copied, but self-control must be developed. When you gain control over your thoughts, your emotions, and your actions, you stop reacting to the market and start operating with intention. And that is when trading shifts from being chaotic and stressful to structured and controlled, opening the door to long-term success.